meeting minutes day. That means it's a Wednesday. Oil inventory day as well. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never, ever, ever risk money you cannot afford to lose. Hello, my name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Thank you very much for being a client. If you are new to these webinars, please visit TradersWay.com and open up a demo account. It takes less than 30 seconds. Then you can download MT4. Then come back to this video. In the description below, you'll see that there's a link to download my chart templates for free, so you can then install that into your new Traders Way MT4 account, and your charts will look like my charts. You'll have my pivots, you'll have my indicators, you'll have my templates, my profiles, my everything. Cool. And then 3, don't forget to subscribe and like and all that kind of stuff. If you subscribe, then when I do these webinars, you will be notified. And if you happen to be available, you just click a button and it brings you directly into the webinar. Pretty cool. I stink. So howdy. You want to cover some trades today? We can do technical analysis, I would say. Would be a good one. Dollar pairs, yen pairs, gold and oil. The familia. And of course, please make requests. I'm happy to try to cover them in our hour and 15 minutes. So once again, thank you very much for being a subscriber of Forex.Today YouTube channel. Alex says, those templates are awesome. I know, right? Why can't teenagers stand in groups of 3? They can't even. All right, cool. So let's go. Do a news trade. Yep, grown. Cool. Where's my drawing tool? Let me fire that sucker up. Okay. It's where we started the month of February. That's a bearish entry. And the target is here. So we missed it by a few pips. Okay. Higher high, higher than this high. Okay. 5 pips shy, yep. So you're thinking inverse head and shoulders. You're also thinking higher high, higher low, but you're also, this is a bullish buy zone based on weekly swing trading. Right on, Alan. Booyah! You're going to enjoy the swing trading course because you'll learn things like pachow. Right on, Alan. I thought you did that a couple of weeks ago, though, right? So here's an interesting question. Does it mean we're no longer bearish? Well, what it means is, yeah, yeah, maybe two, yeah. What this means is bears have taken profit, but it doesn't mean they've gotten out of the market. So it really comes down to how bullish you are, if at all. Okay. So the way I kind of look at that is I try to back out a little more. And does it look like a lovely trend? Does this look like a good trend? Does it, you know? And I'm like, nah, but it's not bullish, right? So I think you're obligated to think about something like this. Doesn't mean it has to do it. This isn't like, there's a wick up here, isn't there? No. To me, it's sort of still rangy. I mean, look, it did break out, so you have the opportunity to trade this pullback. But I guess what I'm expressing is I'm still not like incredibly enthusiastic. This trade was a decent trade. It was a trade. It was a trade. That's all. It was a trade. Good one, though. I mean, look, it worked out, right? So you guys starting to pay attention, like where you are at the beginning of the month is important, right? Where you are at the beginning of the week is important, right? Where you are at the beginning of trade sessions is important, right? Is it Asia open? Right? Right? Is it Europe? Is it, right? So on and so forth, right? So being at the right time and then employing the right strategy is a big part of what we do. Right? Being at the right place at the right time is very important, but these things are very predictable at this as well. Well, I don't know where you live, Michael, but the meeting minutes are today at 2 p.m. Well, unethical asks about the stock market related to bonds is really what you're talking about. So unethical, just hypothetically, let's say you had to choose between earning 5% in the stock market because that's what you expected it to do this year because we're late in the business cycle, or you could pick up 5% in a bond. Which one would you do? Oh yeah, I definitely talked about it in the past. But what would you do? If you anticipated 5% in the stock market, would you do that, or would you buy a bond for 5%? Botman says bond. What do you say, unethical? Sure will be, Chuck. Okay, why did you choose bond, unethical? Okay, well, professional money managers and institutions and stuff, they're making the same decision as you. That is, guaranteed is not quite the right word, but yeah, we'll go with that. Okay, so how are they affected? Well, if you think the stock market's going up 10% and you can only get 5% in the bond market, you might say the extra 5% is worth the risk premium. Okay? And of course, what do you do if the stock market's going up 20% and you're a corporation trying to raise money from the bond market? Well, you're going to have to attract people to loan you the money by offering to pay a higher interest rate. If the stock market's falling and everybody's getting out of the stock market and they want to buy a bond, and you're, let's say, a company trying to raise money, you don't have to work very hard to find people to lend you money because they're cashing out of the stock market. And you're like, well, yeah, I can pay you 4.5%. And they're like, good, boom. And they lend you the money. Lots of people have money. You don't have to pay very much. So anyways, that's how they're related. An institution. So I've been asked to write a research paper for Harvard on my risk management proposal that I gave the school for managing risk at endowments. And one of the big things that any endowment, whether it's a museum or some other artistic institution like your local symphony, your local opera, maybe it's the zoo, I'm not sure if they're endowments or not. Insurance companies are basically endowments. But what do you do when you have to make 8%? What kind of portfolio do you build? How much risk do you want to take? How much goes into equities? How much go into bonds? And I was actually very, very, very shocked at how aggressive endowment institutions are. They're crazy aggressive, in my opinion. It's really nutso. Like, they're heavily invested into hedge funds and alternative investments and stuff. It's crazy. Excuse me. Talk amongst yourselves. Anyways, if you're an endowment manager now, investment advisor or manager or whatever, you have to decide, what are your future expectations for the stock market? What do you think you're going to make this year? 10%, 5%, 2%? Are you going to lose 10%? And based on your future expectations, you need to build a portfolio that's going to get you to your target. Now, a museum that only makes 5% in the stock market is going to have to lay people off. Let me tell you, they don't want to lay people off. Right? Cut the docents! They don't want to do it. So how are you going to make your 8%? And that's, unfortunately, they don't use risk-adjusted returns enough, I think. But anyway, so you have to make up your mind on what sort of mix you're going to invest in. So if you think the stock market's going to fall, you're going to buy the bond market because of its safe returns. Your safe expected future return. So you could buy a 1-year treasury and earn more than 2%. Or you can go into the corporate bond market and see if you can find, like a Ford Motor Company. You could probably lend them money and get 4 or 5%. The issue, I think, is how do you get to your 8%? Maybe you got to have a leveraged bond portfolio. Now you leverage up. If you can leverage 10 to 1 and you're going to earn 4% in the bond market, well, maybe you can leverage up anyways, right? Try to get your 8% down. Even just 2 to 1 leverage might do it. So there tends to be an inverse relationship between the stock market and stuff, right? So if interest rates are going up is another way of looking at it. So if the Fed funds rate goes up, other yields or interest rates tend to go up as well. And eventually money gets expensive and it's hard for corporations to borrow money. Let's say the typical example I give is a shoe store needs to borrow a couple of $1 million from a bank to buy inventory, right? That's what banks do. So you lend the shoe store money, they buy shoes, and in a few weeks the shoes arrive, they start selling the shoes, and then they pay back their loan. But over time that loan might be 4%, then it'll be 5%, then it'll be 6%, then it'll be 7%, following inflation and all that kind of stuff. Eventually the companies are not that profitable and the stock market comes down, right? So it's really, in the end, it's really the price of money. All right. Let's start. I guess we'll just start here. Look, nothing's really changed. Anyone can see. If you were a bull, you bought it here on Monday. This whole area was your buy zone. If you're a bear, somewhere in here is your sell zone. Go. Like I said, if you do it right, one of you will make money and the other one won't lose money. Cool. Anyone can see. Does that make sense to you? I like looking, like so many people make such a big thing about the central, but you have to be in the right position and all that kind of stuff. So like for a bear to be below the central and then you retrace back, that's a beautiful sell. Okay. If you're a bull and you're above, you know, buying the dip is the right way of handling it. Did you say the 200 EMA? Well, no. If you're reading the 200 EMA this way, it just means there's no market. Okay. No trend, actually. Okay. That's what that means. No trend. It's not up. It's not down. There is no trend. You can delete the 200 EMA. Okay. So in that situation, you tend to use oscillators. Yeah. But you can see I've already marked it up as a range, right? I've already done this. Okay. How would you plan this out? Absolutely, Michael. Alejandro said that was a great answer. What question was I answering? Anyone can see. Yeah, that's even a better one there. And notice, like, bears, what was the weekly plan for bears, right? They're trying to get down to here. Yeah, that makes sense, Brooke. Buying it where, you know, at a bearish target, makes a lot of sense. Oh, okay. Cool, Alejandro. Thank you. Okay. That's plausible as well, Brooke. That's even better than having to come all the way down to here. Yeah, inverse head and shoulders, yeah. So you need a big decline in oil, which means a big decline in the stock market, which means a big rally in dollar. So that would be very bad economic news, would drive this sky high. So you to get that to work, you want S&P 500 down. Okay, you want oil down. T-note up. JPY up. Swissy up. USD up. Aussie down. CAD down. Kiwi down. Easy. It's all the same trade to me. Couldn't care less which one. Do them all. Raymond says, look like 6 weeks consolidation before a big move up. Well, yeah, so what actually tends to happen is we'll probably get 2 decent moves between now and June. And then consolidation for much too long. And then new cycle. Yeah, Ben says, but if you're long oil, wouldn't you want USD CAD to fall? Yeah, so that's why you have to, if Brooke says, you know, this is the bigger move, then the next question is why? Otherwise, it's just an opinion, right? Nobody cares about that. So it'd be more like why? What's going on in the market to cause that? Right? And why is where things actually should start. So like if we were working in a hedge fund together, I could come in, and we're doing an all hands meeting, and I come up with some disastrous scenario, and I say, what trades do you make? Right? So like I could say, massive earthquake in Chile. What do? Why? There's a huge earthquake in Japan. What do? Why? Yeah, Brooke, but that's a long ways away. I'm interested in going out there and buying stuff, but I need the change of government. I need the change of government for sure. And if you don't buy directly in Venezuela, that may be Curacao or Aruba or other places to look. So if you're thinking, let's say 10 years in advance, will Venezuelans be able to vacation in Aruba or Curacao? Well, right now they have 1,000,000% inflation, so maybe 10 years. More likely it'll be, your Royal Dutch Shell employees working in Venezuela, right? Bringing the oil in, making the money, and then going on vacation in Curacao. Okay. Oh, you're in Chile. Land of the earthquakes, for sure. You know what I love for Chile is, is the Carmenere. Love Carmenere. Okay. Gold. Oscar Mike, huh? The target is, I can't even see it. 1348, I guess. According to this, I might even consider it going to the next one, which is there. Uh, 1357, 1357. What do you guys think for a target? Yeah, look how gold performs so typically, right? Up, consolidate, up, consolidate, up, consolidate, up, consolidate. Nice, right? Just not this month, Benny. And it's not expected so far based on this move. Still not even expected next month. So probably longer than you think. But yeah, it's plausible, sure. Okay. Is that right, Brooke? What was the reasoning? Because the entry is predicting an R2. All right. That's an old one. the overstretched Stokes. One thing I want you guys to remember when you add a Stokes, and I guess I'll just add one. Where is it on the? I never add it this way. Okay, the one thing with Stokes is it can sideways does not mean get out. Sideways means everybody on the planet is buying it. So for example, even this is occurring in a period where price is going up. So stochastics is not a good indicator for such a thing. Okay. So for example, the right way to use the Stokes in this uptrend is not getting out on when it's moving down, but getting in when it's oversold. And another thing that I used to say is, stochastics can stay overbought for a very, very, very long time. Okay, so you got to be careful. I wouldn't use stochastics that way. Okay, and I guess this is the best example of it. I mean, what? Hang on, let me do it again. I clicked the highlight. There we go. I mean, look at this period, huh? It was a great one. Look at this. Right? Doesn't say get out. So just, I don't know. Don't use it that way. Yeah. Yeah. But you should study this really. It's an important thing because there used to be something that came up a lot back in the day, because I would trade with the oscillators a lot more, right? I would show them a lot more. I found that most people get them confused. They don't use them the proper way. So like, just in simple terms, like I was saying before, based on other analyses, I say I'm bullish because of the 2155 cross. Okay, I'm bullish because of the 2155 cross, all that kind of stuff. So I'm looking to buy the dips. Even these are not great, but you can see I'm not doing them to sell, right? I'm buying extreme dips. The other rule is, you have to be at support and you have to be above the 80-20. Where's the 80-20? I find it hard to see with the setup here, but so there's the 80, and where's the 20? Here. Okay, so it's not going to make me bullish. It's not going to make me bearish. I'm already bullish or bearish, and now I need to identify support on pullbacks. That's a buy. See? That's a buy. Not a buy, 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 not a buy. This is a buy. This is a buy. This is a buy. This is a buy. And if you want to be even more conservative, make this 1585, or I've even done 90-10. Brooke, Michael said the direct correlation between gold and dollar. Well, gold was the nickname for it was the anti-dollar. Yeah. Well, Brooke, so I'm just pointing out little things that that might help. These little tiny pieces, they add up into other things you already know or going to know and all that kind of stuff. But this doesn't necessarily mean bail out of your awesome trade. It might, but it doesn't have to. A better answer would be your analysis tells you that because of this entry, R2 is the target. I'd rather go with that. Okay. But then reverse everything I just said. I just explained one really awesome way to get into a trend. Right? And then, of course, a lot of people back 100 years ago, people would go to the Holiday Inn and go to some get rich quick course on trading, and they're like, yeah, look, you buy low and you sell high, and you buy low and you sell high, and you buy low and you sell high, you buy low, you sell high, you buy low, you sell high, and everyone's like, oh, that makes so much sense. And of course, it's dumb. Brooke, well, that's sort of irrelevant. You're either improving or you're not. So if you bailed on a good trade because of some sort of silly reason, then that's the issue. I don't care how many pips. Right? If it was a 2,000 pip trade and you got out at 444, you still have to, yeah. I say, excuse me, gee whiz. I say the most important exit for me has to do with pivot points. Okay, so get sort of hard and fast on the R2, S2 ideas, and it can be weekly or monthly. Ideally, it's combinations of both, depending on what trade plan you originally had and when you originally got in and all that kind of stuff. But the only hard and fast rules I've ever had as far as exits is always, 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 always get out at R, or in this case, S2 and R2, which is way up here. Okay. Give you examples. Here's an R2. Here's an S2. Well, just barely missed it, but you get the idea. Okay. R2, S2, and R2's up here. Okay. And the typical speech I give here is the law of averages. Most of the time you stay within that range. Sometimes it will go far beyond. But over 1,000 trades, you're going to get the average. So you might as well just take the average. Most often, you're going to do best. Well, Michael says, if Michael was set in a bullish trade, I would at least take part of the profits of it. Well, see, now that's going to be a judgment call, but like why? Because you're afraid? Why would you take off half the profits, right? So if your analysis says it's going down to the target, then go down to the target. Right? Trade your plan is what I'm trying to say. Okay. Do I recommend being so stubborn you don't react to changes? No, I didn't say that either. But trade your plan And then when your plan has obviously failed, then take it all off the table and just move on. What you want to do is remove hope, but you also want to remove fear from your trading. Just do your job, right? It's just another trade. There's so many trades. And that's why very often you see like new traders, they make 3 trades a day, or I've even seen 3 trades a week. And they're so married to these trades because there's so few trades that they have to make these hit. Well, if you had 30 trades open, you don't give a damn about any given trade. You're just kind of moving your stops and hitting your targets or not hitting your targets, and let them work out. Most people, when they only got 1 or 2 trades going, they have too much riding on these trades. And P, those are the targets. And P, why don't you take the swing trading course? Renko says round numbers to exit. No, not necessarily. And also with the round numbers, it depends, is the next answer. And I'll give you an example if I can. Excuse me. Let's do blank. So how am I going to do this? What's in my mind? So we'll call this 0, 0, 0, 0, 0. We'll call it X 0, 0, 0. So it's a big number. Above that, you're going to have 20, X 0, 2, 0. You're going to have X prime, subprime 0, 80. Okay. So these have different meanings. So the question is, do you get out at red areas? Well, they have different meanings. How do I want to say this? If the market is bullish, it's likely to play it like that. If it's bearish, it's likely to play it like that. And then also, if it's not trending, so on a higher time frame, let's say, and this is where I'm struggling how to draw it, you get sometimes these bigger moves. So imagine this over the course of not hours, but days. This bearish move comes back to the 0, 0 and then down. And that's when the 0, 0 itself is relatively important, is when we've basically already broken, we've returned, which means in the shorter time frame, it is already bearish and coming down. So to me, the more important levels are 80 and 20. Uh, 20 and 80. Okay. And this has to do with another rule. You're going to just have to do your own research on this, but many years ago I read somewhere that most trades were 30 pips away. I guess so. It might have been 35. But anyways, I read somewhere that 80% of the stops are within 30 pips at all times. And you can see that when you have a ladder and stuff. So this 80 and the 20 is more important, because if you were a buyer here, your stops are going to be down here. And if you're a seller here, right, then your stops are above here. So your selling range is kind of those 30 pips. Your buying range are these 30 pips. And so like the 0, 0 is sort of irrelevant because there's going to be buyers and sellers there and all that kind of stuff. And where you're going to get paid is where there are more sellers than buyers, and you end up selling at 0-0 on the way down after the breach of the 0-0, retracement of 0-0. Then you get through here, and then you hit these stops, and you go from 80, you drop to the next level, which is 50. And there's going to be some buyers defending 50 now. And sellers, some sellers would have entered way up here at that 50, dropped it all the way down to 80. So now you've gone from 50 pip, from whatever, X50 down to this 80, up to the 0-0, down to the next 50, and then they take their profit because that probably took a whole day. Okay, so the 0-0 in of itself isn't important on its own, because what you end up doing is you get caught in here. But after the fact, it's more important. So a breach of the 0-0, retracement of the 0-0, it's basically a breakout strategy, right? So you let it hit 80, you let it come back to 0-0, you sell near 0-0 once you have confirmation. And if you get that right, you're going to blow through these pivots. Those are buyer pivots, which means to offset their long, they're all sell positions. So your trade cascades very quickly to 50, and that's where you should probably bail. And vice versa if you're a bull. Okay? So which one works is in the context of the prevailing trend. Hey, someone is spamming us with their trading signals. Amazing live signals. Wow. Do you guys want to risk your money with your hard-earned savings, your retirement account, the money that you're putting your children through college with? Should you give it to them? Or should you just learn how to trade yourself? So I am going to remove this guy from our channel permanently. Goodbye, spammer. Well, an Arctic turtle idea is more like this. So let's say you have weekly target here. Weekly pivot profit zone, okay? And so we're on our way down, and you know that's the target, right? But what if 12 pips below that, you have the monthly pivot profit zone? What's the likelihood some of the traders in the market are actually trading the higher time frame and are targeting this? What's the likelihood that even though we're almost to the weekly pivot profit zone, that some traders are really watching the bigger target? They're looking at the bigger time frame. They're not watching the hourly. They're not watching the 15-minute. Weeklies are kind of like scalps to some people, but they're definitely they've planned on the monthly target. Anybody? What's the likelihood they're watching the big monthly target? I guess I got to be careful. A bit of a lag in the chat today. So anyways, okay. So so what happens then is in those situations, both are valid targets, right? So even if some traders that are only using weekly and not using monthly take profit at the first one, some people are much more interested in the second one. And then it snaps back because, well, now at this point here, at the lower yellow point, everyone's getting out because these guys bailed and these guys are now bailing, or not bailing, they're taking profit, right? So what I use the funny analogy of an Arctic turtle. And it comes from an old story, but whatever. The idea is this turtle that's living here stretches his neck out to hit that target. And it very quickly goes back the other way. Okay. Okay. So just imagine a stretch. And then I say, what happens to an Arctic turtle, when he stretches his neck out? Well, he gets chopped off. And that little move ends very quickly. So just imagine, some people just stretching a little farther to get those other 12 pips. Yeah, absolutely. So here's a great example of the law of averages. I said here, you should always get out at R2. Sometimes it goes farther, and sometimes you could even be way up here. But over the course of 1,000 trades, you won't see a difference. What ends up happening is sometimes the market does this, and sometimes the market does this. Okay? On the long run, you're always better to get out here. Now, one of the major reasons you might not be thinking is that if you're out of this trade, you're now planning a new trade, a new good trade. This would have taken you all week to make your money. Well, it'd take you all 3 days to make your money. But now you're free to plan another new good trade instead of sitting here and watching this move around, right? And it's funny and this is particularly true for losing trades. If you're on a trade and you're down like 272 pips or something, and you're just staring at that, and you're praying and you're hoping and all this kind of stuff. Meanwhile, you've missed probably 6 good trades. And what you don't realize is these 6 good trades are probably worth 300. You're losing 300, but you've also missed 300, and you don't realize it, and you're just sitting there compounding your bad mistakes, hoping and praying. You should cut yourself loose. So the very first presentation I ever did at FX Street 15 years ago was based on stop losses. I think it was called 10 Ways to Leave Your Lover. Slip out the back, Jack. Get a new plan, Stan. Right, that kind of stuff. Set yourself free. Slip out the back, yeah. Yep. So anyways, because I said, the most common mistake a trader makes is they fall in love with one of their trades. So anyways, what you can do is play the law of average. Just take your profit, move on to the next trade, right? Look how beautiful this moves. Just crazy. This is sick. Just sick. Just sick. Shonka. Cool. And that's the beast. Yeah, this is the one I haven't been too excited about. Okay. There's a counter trend plausibility if you want to do it in there. Wednesday is sort of iffy counter trend day, but because of that, you can certainly, if you wanted to be a bear anyways, I think if you were paying attention, since that's a 4-hour, you would have taken this a long time ago, more of a scalp. But you can do it as a change of trend. So because of the rules of engagement that we have, you can consider this. I'm not telling you should. But if you wanted to be a bear on this anyways, you know, the table is set, my friend. Okay. Another way to do it using oscillators. Do like I did before. In this case, you're a bear, so you only want to sell high. Okay? So in this case, it all worked out. So here's the weekly target. That's tradable. This is, you know, moderately tradable. This is not a trade, but it might be oversold later. You can certainly still trade it, but it's just the oscillator's not confirming it. Okay. So using an oscillator again, let's do it here. If you wanted to be a bull, maybe a buy, maybe a buy. Nothing other than that, you got to wait. Okay. You see how this is coming down? If it comes down further and then heads back up, then that could be a buy in the future. So maybe sort of somewhere in, sort of in this area, you'd see it looks like kind of a roll reversal anyways. Okay. That would tell a bear to wait, and the bear would wait till it's way up here. So it might even, you know, kind of triple top and then drop. So you just got to wait. Once again, NP, you need to take the swing trading course. If you're missing all these little gems, you should take the swing trading course. I can't teach the whole swing trading course in the middle of our analysis, but you should do it so that these things have bigger meaning. Mary says, why does our brain stop working after watching a loss? You know, the thing is, try not to ever get in that situation anymore. Hey, no worries, NP. But you're asking good questions, but you're also saying to yourself out loud, hopefully, because, you know, everyone else in the chat room doesn't exist, right? It's just you and me, right? Everyone else is a figment of our imagination, unless you're actually sitting in a room with someone else in the chat room. So, you know, you should just say to yourself, well, I'm admitting out loud that I don't know how to swing trade, but clearly I'm interested in knowing how to swing trade. So you should very, very seriously consider taking the swing trading course. Well, yeah, so Alan says, talking about the stop loss, I think the pivot will help a lot when you don't know when to take profit. But that's what they're there for. They tell you entries and exits. That's the wonderful thing about pivots. They tell you entries and exits in advance. Days in advance, weeks in advance. But that's the whole point. They're pivotal swings in the market, right? So yeah, so that is the whole thing. Luku, Uso. Kiwi, I guess. I know. I trade you. It's a very mediocre trade, but we can kind of go back. Okay, this was a bullish buy zone. This was the target for that week. This was the bullish buy zone. This was the target for the week. We never hit that, but it was bullish for a week and a half. Then this is a bearish sell zone, and the bears took it down. This is what their target was, but down into a bullish buy zone, and this was the target. And then we opened this week, and it's still bullish, but we're out of position. So you got to use the 4 hour, as you know, the 4 hour 21, which worked. But I mean, it's following every rule to a T. But this is like, it's a bit slow. So now that it's Wednesday, so for example, when you open out of position, typically this is your entry, right? But usually by now we're up here. So it's doing everything okay. It's just really slow. And that concerns me. The rate of change isn't there, which means nobody's selling this. And there are buyers. They're just not buying it very aggressively, right? I agree with that, Jimbo. Absolutely. In many cases, I think most people, or many people here, are intellectually capable of learning technical and fundamental analysis and still not being successful. And so a lot of what I need to do as sort of the leader of our community is work on ways to reprogram your brain. And it's an important thing. But again, that's why you have a coach. Like, pick any sport in the world, right? And they all have coaches. Like, why do you need a coach if you have a soccer team with all the best players? Or a basketball team with all the best players? Or you're the #1 golfer in the world? Why do you need a coach? You're the best. There's nobody better than you. And most of the time, it has to do with the psychological aspects of competing. Well, what do? We're like athletes. We're like soldiers, right? It's a zero-sum game for us. There's a winning team and a losing team. Over and over and over and over and over, right? Yeah, Tom Brady has a throwing coach. I mean, so like, why do we do it? Well, because it's necessary. Question is, are you coachable? It's going to be about the same. There's not a lot to add to a lot of these, and everything. Like, do you remember the whole idea, guys, that there was going to be a giant drop in the stock market at the beginning of January? Then starting in the 3rd week of January, there'd be a false rally. It could be a pretty big rally, but it's not going to make a higher high. That's still been generally true, right? And so what happens after that? So we predicted a big drop, a big return, a counter move, and then a down, and then an up, and then consolidation. Actually, back before the financial crisis of 2007, I started a tea company for fun, something to do with my money. So I love tea. I just don't drink a lot of it. But I love tea. I just don't drink a lot of it. But yeah, I started a tea company. Had bags of tea in my kitchen, sampling from all the different plantations. I had the packaging ready to go. I had struck a deal with Amazon to hold all our inventory and manage the inventory system, and I hired a call center to take orders. And it's pretty neat. Never launched it though. It's just like a hobby. Some people golf. I started a tea company. But I'm not going to tell you what kind of tea. It's proprietary tea. Yeah, Thuso, you should tell him he's an idiot too. Just amazing what people would do. What arrogance to say you don't need a coach. Really, like, why would you not want to analyze yourself? Obviously, you're either stupid or you're afraid. Right? I don't think it's a sad story. I think it's logical. I don't get emotional. Like, the emotion there is just like, nothing. Like, well, that makes sense to me. You don't need a coach. You're going to go it on your own. You're going to sell an asset that you shouldn't be risked, and then lose it all. Well, all of that totally makes sense to me. It's very, very logical. So it's no emotion whatsoever. Now, he's probably very emotional. He was too afraid to analyze himself, especially have an outside person analyze him there. That's usually a fear issue. What was the motto? I don't think it had a motto. But anyways. Merritt, what about the Turkish lira? Well, you notice I even tried to stay away from the British pound around Brexit. Not that it's not tradable, but it's really strange volatility and really odd technical analysis. And you can have a good trend that just gets whacked because of some Brexit-related thing. So I try to stay away from what's not conservative, repeatable type trading. Turkish lira is way out there too. Okay, so I don't want to look at it now. The trading of emerging markets has been very, very, very good. But I'm not taking a group of young traders and throwing them into trading, frontier market currencies. But I can tell you, when I did a lot of talking about the Turkish lira, it was before the massive volatility took place. But we talked about it in terms of yield, right? Not in terms of pip. In fact, I said if you made no pips at all over the course of a year, you would make X amount just in yield, right? And I think we're up to, I just looked at it the other day, like 220% return for the year based on the amount of money you risked and how much you've earned in interest. But beyond that, it's not your average everyday currency. I mean, it moves 1,000 pips a day. Right. Yeah, it's all about the swaps. No, but even the pips are great. I mean, literally, it moves. It moves actually probably in some cases 2,000 pips a day. But that's not conservative, repeatable trading. Yeah, but if you lend the country money, it's 20%. So anyways, guys, what do we call it a day? Remember, it's all about the meeting minutes. Are you actually going to download the meeting minutes and read them? You would have to go to, I don't know. You'd have to go to the website and download it. I mean, I don't know why you guys fight me on these things. I'm like, look, the secret to success is just going to these types of websites. Look at this. The FOMC Longer Run Goals and Monetary Policy Strategy PDF. Look, you know what? I mean, they just tell you. It's so amazing. And even more amazing, there are people managing billions of dollars that don't even read this stuff, and it's because they're in it for, I don't know, because they're stupid and emotional. I don't know what they're doing. They're uncoachable, let's put it that way. But anyways, they actually tell you what their strategy is, and that kind of information, you make money. So Ben Johnny says, from where? Yeah, from Google. I don't know, Google it, find it. Your life depends on it. Figure it out. Thanks, CEO. Thanks, Chris Davis. Ricky Bobby. Anyways, yeah, let's call it a day. I'll see you tomorrow. Make sure you read those meeting minutes if you take your life seriously. So peace on earth. May the pips be with you. May your profits be above average. Don't forget to click the Forex.Today YouTube logo there to subscribe. Feel free to download my chart templates. They're in the YouTube video description below. And please open an account at tradersway.com. See you tomorrow and the next day and the next